Welcome to part three of the series. I wanted to start with a couple of different things. We've shown some illustrations. We talked about a 35-year-old male boy. Uh, and I wanted to point out that, some people will say, well, what you're showing us is not me. It's not my situation. I'm 65, can I even do this? And there's a couple answers to that. One is, yes, you're no longer 35, but you may know somebody that's in that, that's younger that could take advantage of this um, at an earlier age. But it's not too late for you. If you're 65, 66, it's a concept, right? It's what is called the infinite banking concept that R. Nelson Nash created and developed. And that is that you have this idea of banking and where you put your money. People will put money that they're going to need to spend every month to put it in the bank. That makes sense. But to warehouse it, to have, any extra money sitting there, most people think, well, then I've got to put it into some investment. I've got to buy real estate. I got to buy stocks. I got to buy mutual funds. I need to get a better return. And that's the reason that they may not leave, much excess cash in the bank if they have it. But many do, and neither is the only solution. There's not just two solutions, which is that I've got to invest it, I've got to put it at risk. Maybe I'll hit, a double, a triple, a home run, a grand slam. But there's a little bit of nerves with that because you don't know how it's going to play out. And I'm not, saying don't consider it or even do those types of things, but they're not the only options. And what I'm trying to show you is this thing called the infinite banking concept that was first written about in a book called Becoming Your Own Banker. Now, there's a lot of reflection, and I'm sorry, but you can look it up. You can find it on my website. But there's one thing that I wanted to focus on before I get into some more details from the previous two videos. And one is, in this 92-page book, that really is a little bit less than that, when it comes down to the story. It's really only like 86 pages. And on page 21, so not too deep into it, Nelson writes, the very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. Now, you're giving up that interest and you're giving up the money that interest could make, which is called compound interest, right? So I wanted to start with that. Many people think about this platform that we use for the infinite banking concept as a cost. Life insurance is a cost. Life insurance is the platform, is the vehicle that I'm using to try to bring back money that you were letting go and having somebody else do whatever they're going to do with it. Maybe make money, maybe lose money, but you pay cash, that money's gone forever, right? Never to make money for you. That money will never make money in the compounding. And the fact is, what we're trying to do is use somebody else's money and leave yours alone to grow. Okay? You use your money as collateral, just like when you collateralize your home for a home mortgage, right? They're lending you a bunch of money based on the value of that home, or what they say the value is, right? So with an insurance policy, you build up cash value. You have an asset. and then you utilize that asset as leverage, as collateral for you to borrow their money, to borrow the insurance company's money while yours continues to grow. And I want to use a quick example that I've used with one of my prospective clients. Trying to keep it simple, but I'll show you more in this video. So let's say you had the money in your bank account or in your wallet to pay for a night out. And that night out would include dinner and going to the theater. So let's just say, for all intents and purposes, which may be hard in some parts of this country, but let's say with tip, decent tip, it was $50 for you to take your significant other out to dinner. So there's $50. You have the money, but let's use two different stories here. One is that you take the $50 out of your pocket and you hand it to the waiter and the wait staff. And then you go down the street and you go to the ticket window at the theater and you buy 2 tickets for the show for $50. You have another $50 in your pocket. You take that out, you give it to the teller at the window. And then the next day, right, you say that was a lot of fun. And you look in your wallet and you realize, yes, there's $100 less in there. Okay, let's say inside a policy, you had the cash value that you could use as collateral. And so you decide, I'm going to borrow the money. So I request it online, they drop it into my account, and then I've got that money in my bank account. Now, it's not my money. It's the insurance company's money. And yes, I'm paying an interest charge to use their money. But I left my money in my policy, and that continues to grow. Technically grows every day, slightly every day. And then it has a chance to share in basically the profits through dividends. And those dividends, once added to your account, never go down. They never are lost in the market or anything like that. That's rock solid. It's yours, and it only grows from there. Okay? They're not guaranteed, but they have been paying them for over 113 years. Okay, so let's go back to this example. You've borrowed the money, they dropped it into your account. Now you go to dinner and you take out your debit card and you hand it to the wait staff. They take the $50, including the tip, and then you go down the street and you go to the teller window at the theater, and they tell you it's $50 for 2 tickets, and you hand over your debit card. Now, the 50 that came out at the restaurant and the 50 that came out at the teller window for the theater is the insurance company's insurance general pool of money. So it wasn't yours. Again, yours is still in the policy and it's still growing. Now, the next day you say, well, you know what? I have the $100. So I'm going to send the $100 and pay off that loan. But I'm going to send them an extra 2 cents because that's what it cost me to cover that overnight. Now, I have access to that to leverage that $100 again in my policy because I've taken that lien that was on my cash value. I've taken that off because I paid it off. And it cost me actually less than, at the rates currently, it would be less than 2 cents for the overnight loan. But regardless, you sent them 2 cents. It's like 1.5 cents. Now, if you compare that to have access to that $100 again, right, to be able to leverage that again, you compare that to your bank account where you or your wallet, right, which came from your bank account, right, probably, or what have you. When you gave the money out of your wallet, you gave it to that wait staff, and that's gone. You don't see that ever again. That's not working for you. And then the same with the theater. You gave them $50. That's gone. So the only way you have access to another $100, or to roughly that same $100, is to put another $100 into your wallet. Go out and earn it, put it in your wallet. Now, that sounds like $200. The 100 I spent and the 100 I had to earn to replace it, as opposed to I only spent $100 in the first case, and it cost me 2 cents for the overnight loan. Now, it could go run days, so it could be, 6 cents, 7, 8, that type of thing. But the fact is, you just spent the money once, not twice, to have access to that 100 again. All right? I hope that's helpful, but please call me, talk to me, send me emails, question me on this, okay? Because this is really, really important. All right? So let's do this. I'm going to share my screen. And I want to go to the policy that I was talking about in the previous video. I talked about $59,000, which is what you could distribute out of a policy, and technically for 30 years, right? From the age 66 to 95. And I tried to say, what is the probability that that will be available? And I got up to 99%, give or take 1.25%. Now, I also showed that after we took the taxes out of a portfolio that grew based off of a 30-year real rate of return in the S&P, that for you to have that same probability, you would have to go down to 43,000, not 59,000. But I just wanted to show you this illustration. Now, these sometimes can get overwhelming for people. That's not the intention. I'm going to try to focus on particular parts of it. Let me go to first the tabular detail. And I really don't get bogged down by all these numbers, right? This is overwhelming maybe. Okay, sorry. Hang on. Let's see if we can move this. All right, and let's go. I'm not sure I was on the right illustration, so bear with me. Okay, so we talked about 20,500 because that's the maximum you can put into your 401k right now if you're under the age of 50. This is a 35-year-old male. It could be a 65-year-old male. We don't have, let's not get hung up on that. But the point is that we want to look at, I did this in this policy for 30 years, okay? And then I went and tried to figure out if I wanted to distribute, to take income, to create my own pension. It was going to be $59,176. And we can get into all the details, but this is where you have to engage with me. This is real. This is not, some scam. This is, the insurance industry, life insurance industry has been around for basically longer than the country has been around, about 250 years. So first it comes out in what we call cost basis. So these first number of years, you can see it come out under this, what they call partial surrender. Don't get caught up in any of these other columns, but eventually you start streaming out as loans. Now, because you have the collateral in there, right? Meaning you have this cash value, you're not going to go and run out of money, because I said, let's run it so that I can distribute income, cash flow, technically, right? Cash flow is different. Cash flow isn't taxable. Income is. And we can get into even more about that when we engage. But I wanted to show you that this takes you 59,000, brings you to age 95. And that was the same 30 years that I used in that nest egg calculator, right? It was 30 years. So I do want to show you that, some people say, well, okay, so what if I put that in and you're saying 59,000 probably wouldn't be enough for today. It's probably not going to be enough for 30 years from now. Gosh, this doesn't even work. Well, yeah, I get it. And you'd say, well, okay, well, can I put more in? Well, potentially you can put more in, and you really should seriously consider putting more money in. And what if we doubled that amount, right? That I was going to put 20,500 in, and I decided I want to put, well, how can I do that? Well, think about some of the expenses that you have, right? That you would automatically be paying anyways, and you have regular new income cash flow coming in, but you're saying, but I don't want to be committed to this 41,000. What if I can't do it? Well, if you could commit to the 20,500, well, this would give you the room to put up to 41,000 and potentially create a much big, well, if you put the 41,000 in for the same 30 years that we talked about with the other illustration, then you're going to have a lot more that you can distribute as your personal pension later in life. But I have created this illustration to show you a couple different things. One is that in these policies, you have required premiums. You have a required premium for the first year, but the minimum required premium is this amount, which is slightly less than the 20,500. But it allows you in the second, third, all the way up to the 30th year to put in this 41,000. You aren't required to, but if you push yourself, right? And I'll tell you a couple of reasons why you'll want to push yourself. One is, well, let's look at it. Instead of 59,000, when you go to stream or distribute this money, you're going to distribute 114,747 a year, not 59,000. And the fact is, let's go back to the fact that when you're putting this money in well before retirement, you're 35 years old, you have some things you want to do, maybe some cars that you need, vacation trips that you want to take, that you may use credit cards and so forth. And hey, cash back, I get it, all that stuff, but let's just stick with, hey, I'm using some other credit or I'm using my cash. Well, don't use your cash. Use somebody else's cash and let yours continue to grow. And as yours is growing, let's look at this is the dividend side. It's non-guaranteed up front, but once it's locked in, once they pay this annual dividend, it's in there. It's not going down. It's not going to get lost, right? It's not like a stock dividend. If you roll that back into your portfolio and the market goes down, a percentage of your dividend goes down with it, right? So what I want to show is the fact that, hey, let's look at, age 40. What's your net cash value? You don't have to wait till retirement to use this money. You can leverage this money anytime. When you have the cash value there, you just ask for the loan and they give it to you. No questions asked. So you're looking at, at this point, almost 200,000, right? Maybe you need to buy a car. And what you do is you borrow it from the insurance company, and when you pay it back, let's say it was 50,000. Okay, you're going to continue to try to put in this maximum contract premium over here. But let's say it was 50,000. Okay, let's say it took you 5 years to pay that off. So, let's just say it was, you know, year, let's just go to year 10, right? And say, okay, I put the money back in, I paid the 5% interest, that's the current rate right now. Regardless, you have, and everything played out the way that they're projecting here based off of today's dividend rate, and you put in this 41, you would have 456,000. Plus you'd have the car. You wouldn't have taken, 50,000 from here. You just would have leveraged it. So it would have, when you paid it back, even though right now, like if you took out 50, well, my net cash value that I can use as collateral would only be 146,883. But once you pay it back in, you would have all 196 plus all the other growth that you had. You'd be right back here. Plus you'd have, okay, maybe you'd have a 5-year-old car, but you'd have access to that 50,000 again. That's the power. And look at these numbers keep growing, right? They don't stop. That's not the way these policies work, right? Again, there's guarantees, and then there's what has been paid out historically. Is there's a dividend that's paid. Again, not guaranteed, but they've been paying them for 113 years straight, right? Through all kinds of conditions. So you're 50 years old. Now you want to, I don't know, buy a second home, put a kid through college, possibly, pay for a wedding. You don't know. I mean, there's all kinds of different things, but you don't have to take out all 776, but you have all these numbers, or numbers that you can leverage as time goes on. So that's the power of this. And I'm going to leave it at that. And I will continue this this series of videos. There's much more to say, and thanks for joining me. Please reach out, like the video, reach out to me. You can reach me at my number, which is, well, let's not leave my number. You've got my number because you're part of my mailing list. Thanks. Take care.